In this lecture, I am going to explain about the journal entries for the partnership related to the admission of the partners, then bonuses to the new partner or sometime to the existing partner, and the withdrawal of the partner. It means when the partner is going to leave the organization. So what I will be covering, the first that will be admission of a new partner, then what will be the new agreement, journal entries related to this, that admission of the partner, investing assets in a partnership firm, bonus to old partners mean existing partners, bonus to the new partner means upcoming partner, and withdrawal of a partner, then death of a partner. So what will be the journal entries at the time of a withdrawal of the partners, or when the time when there are three partners or two partners, the one is dying, so what will happen, right? So starting with the admission of a new partner. The admission of a new partner dissolves an existing partnership and can occur in one of the two ways. Either the new partner can purchase the existing partner's share, or the new partner can invest additional capital into the partnership. There are two ways. Now, the new agreement will be formed if the existing partners agree to the new partner joining. A new partnership is formed and new partnership agreement is created. New partner must be accepted by all current partners. I'm just going to explain this concept with one example. So for the admission of the partner, assume that at the end the RJ Electronic Company's third year, Rex has a capital of $20,000 and Rex sells one half of his partnership to Leo, means one half of the partnership interest to Leo for $18,000. On January 4, John is selling $10,000 and a record the interest would be $20,000, and that will be 50% of that will be $10,000 in the partnership. So how that we will record this journal entry? So in this case, let's say the John here, the $10,000 that will be debited and Leo's capital that will be credited here. So Leo is a new person who is coming in the organization, and the $10,000 that will be credited. Credit mean that the equity has increased, and debit mean the equity has decreased. Okay, so now in this case, what will be the statement of a partner's equity for the year ended on 31st of December? We know that there were three partners, and Rex and John. So Rex was having $20,000 at the beginning and John was having $50,000. And the new partner that has come in the business, the name of the new partner is Leo. So Leo has entered into the business, but in this case, what happened? The Leo has bought 50% share of Rex. It means the $10,000 that will comes under the Leo's capital, and $10,000 that is reduced in the Rex capital, because Rex has sold his own share to Leo. But in this case, note that the two aspects of the transaction are very, very important. The first one is the $18,000 that Leo paid to Rex, but they have just considered only $10,000. So what does it mean? So the $8,000 that will not be considered. That was their personal dealing and personal interest. So the partnership assets, liabilities, and the total equity are not affected by this transaction. As you can see that at the beginning of the session, the beginning of the year, the total capital was $70,000, and at the end of the year the total capital is also $70,000. But what happened? The Rex share, 50% share, is transferred to the Leo. right? So 50% of 20,000 is a $10,000 which is transferred to the Leo, but Leo brought $18,000 in the business, $8,000 extra. It means $8,000 that will be the personal profit to Rex, but which will not be recorded. There will not be any journal entry for this, because that will be the outside dealing, right? So this is the transaction when the new partner comes and buy the existing partner share. Now, second scenario is investing assets in the partnership. Admitting a partner by an investment of assets is a transaction between the new partner and the partnership. The invested assets become the partnership property. So in this case, that I'm just going to explain this one example. Let's say if Rex with a $20,000 interest and John is having a $50,000 interest, means $20,000 capital for the Rex and John is having $50,000 capital in the partnership firm. Now both of them agree to accept Leo as a new partner in the RJ Electronics company. So with his investment of $28,000, right? So the entry to the Leo's investment, that would be cash $28,000 has come in the business to Leo's capital 28,000. So in this case, what happened? That cash has increased in the organization and the Leo's capital is also increased in the organization, right? Now, the statement of partners' equity for the year ended on 31st of December. We know that in this case, the capital has increased because the new partner has brought something in the business. New partner has invested $28,000 cash in the business. In this case, the new partner, which name is Leo, is not going to buy the existing partner shares. It totally is investing some money and taking money with him and joining the partnership firm RJ Electronics company. At the beginning, Rex was having 20,000, John was having 50,000, right? The total 70,000. And the January transactions, the Leo entered into the business 28,000 cash he brought. So the total will be $98,000 investment. Now, if we talk about that Leo has 28.57% of equity in the net assets. If we talk about how to calculate this 28.57 equity in the net assets and liability of the business. So now we know that 20,000 plus 50,000 plus 28,000. What is that? So this is the 20,000, 50,000, 28,000. The total is 98,000. The total money, total capital in the partnership firm RJ Electronics company is 98,000. Now, if we say 28,000 divided by 98,000, that will be the equity share of Leo. 50,000 divided by 98, then we will be able to calculate John capital invested share. No, I'm not talking about the profit share, only capital invested share. 20,000 divided by 98,000, then we will be able to calculate the equity share of Mr. X. In this case, dividing profit and loss is a separate matter on which the partners must agree and document formally in their partnership agreement. Next, we have the bonus to the old partner. What is the meaning of this? Sometime, what happens in the current market value, when the current market value of the partnership is greater than the recorded amount of equity, the partners usually require a new partner to pay a bonus, or which is also known as a premium for the privilege of joining. So now the bonus to the existing partners. So as I have given this example, if for example there are two partners, the one is the Rex and other one is John. Let's say this situation exists when the market value of the net assets exceed the book value, which is often the case once a partnership has established customers and has proven track record of profitable growth. So it means when the company is really growing, very good business, name and goodwill in the market, reputation in the market. So definitely the book value will be the old one, right? But in the real time, the market value will be way higher. When the market value is higher, no doubt the existing partner will say and consider that we are running this business for a long period of time. If new one is coming, that guy, new partner should give some extra money to us. That is known as a bonus or a premium to the existing partners. Now, I'm just going to explain this with one example. Let's say Rex and John agree to accept Leo as a partner with 25% interest in RJ Electronics Company. But they require Leo to invest $40,000. So now recall that the partners' accounting record shown that Rex equity in the business to be 20,000 and John was 50,000, as that I have written here, 20,000 and 50,000. Now in this case, the Leo is bringing $40,000 and the total capital is $110,000. And as per the consideration that the Leo's equity, that will be 25% interest. The Leo, a partner with 25% interest. So 25% of the total capital, that would be 27,500. So 27,500, then that will be considered as Leo's capital, Leo's equity. So this is the Leo equity is 40,000, no doubt. But here, this is this is the total capital we have calculated. So total capital that we have calculated. Now the 25% of the total capital will be considered as a capital of Mr. Leo, the new partner. It means there will be difference 40,000 minus 27,500. That will be the bonus which will be distributed to the existing partner. Look at this. So in this case, what is happening? That although that new partner, this is not Davis, this is Leo. The Leo invests $40,000, right? But the net assets will be recorded in the partnership is only 27,500. The difference of 12,500 is called bonus or a premium and is allocated to the existing partners according to their profit and sharing ratio. For example, it is 50-50. So cash has brought 40,000. This is clear. And to Leo's 27,500. Then to Rex 6,250 and John capital 6,250. It means John and Rex both got advantage of coming and entering or taking admission or giving consent for the new partner to come into the business, right? So in this case, this is considered as a bonus to the existing partner or old partners. So we know that the bonus, the total bonus is the 12,500 divided by 2. This is 6,250. Now, what will be the effect of this transaction on equity? So look at this. The capital at the beginning, it was 20,000 and 50,000 for Rex and John, and zero, and this was zero for the Leo at the beginning. Now investment is made by Leo 6,250, that is added in the Rex and John both, and 27,500 here. The total will be here 40,000 and the grand total will be $110,000. This will be the effect of this transaction at end of the period. Now bonus to the new partner. Existing partners can give a bonus or premium to the new partner so that the new partner gets a larger equity than the amount invested. New partner is investing less money but getting more share. I'm not talking about the profit, I'm talking about the equity share, right? Okay, so this usually occur when additional cash is needed or the new partner has exceptional talent or business connection or new contacts. So look at this. Let's say the Rex and John agree to accept Leo as a partner with 25% of interest in total equity, but they require Leo to invest only $10,000. Both partners are saying that to Leo, invest only $10,000, that's it, but we will give you 25% interest in the total equity. In the total equity, 25% interest that will be given to you. So how? So first of all, calculate the total capital. How much is the total capital? We know that 20,000 and 50,000, 10,000, that will be 80,000. 80,000 is total, and 20%, 25% of the 80,000 is $20,000. So now $20,000 that will be considered as Leo's interest in the partnership firm. But actually the Leo is bringing 10,000, but they will consider $20,000 double. Investing less money, but getting more equity because of his name, because of his quality, because of maybe he is having more contacts. So look at this. What will be the result of this transaction? Leo receive bonus. Leo is a new guy coming, right? New partner coming. Leo has received the bonus of $10,000. How? 20,000 he got capital minus 10,000 he invested. So extra money is $10,000. So $10,000 that he has received. So in this case, the $10,000 that has come in the business because the Leo has brought, and but the capital is increased here. So here it should be not John, but here it should be Leo, right? So it's wrongly written here John, but here it should be Leo. To Leo's capital, it should be 20,000, right? So Rex capital $5,000 debit. It means the Rex capital has gone down, and John capital also has gone down or reduced by $5,000. Rex and John both sacrifice equal amount and given to Leo here, right? The new partner, $20,000. So what will be the effect of this transaction? It means at the end of the period, so 20,000 that was the opening balance for Rex, and 50,000 that was opening balance for the John, and Leo was not having anything. Leo came into existence in the partnership. Now with the $20,000, that will be the ending total, and 5,000 each Rex and John have distributed or contributed. So here this will be the new capital for this company. That will be like 15,000 for the Rex, 45,000 for the John, and 20,000 for Leo. So Leo bonus is 10,000 is contributed by the old partners in the profit and loss sharing ratio, let's say 50-50, and Leo 25% equity does not necessarily means that 25% of any profit or the loss. This is a separate matter for agreement by the partner. It does not mean that 25% equity that he is having in the company, that 25% of profit he will get. No, the profit sharing is totally different, and the capital investment sharing is totally different. Now next is the withdrawal of the partners. Let's say on October 31st, Rex withdraws from the partnership of RJ Electronics Company, and the three partners sharing profit and losses equally. So in this case, the account shows that the capital balance that was immediately prior to the Rex withdrawal. So now Rex is planning to leave the organization. So here the Rex was having 15,000 in the books of accounts as a capital, John 45,000, and Leo 20,000, and total was $80,000. Now Rex want to leave this organization, whatsoever the reason is. Now in this case, accounting for the withdrawal deposits on whether the bonus is paid or not. So in this case, sometime someone is going, sometime the one partner is going. In this case, if there is no bonus, it means whatever the amount that was showing in the balance sheet, the Rex capital was $15,000, and Rex is saying, okay, I want $15,000 only, that's it. I don't want anything else. Neither I want more or less. I want exactly the same thing. Same amount which is reflecting in the books of accounts in the partnership. Both Partners say, okay, no problem, that we are ready with your proposal. If you want to leave, then we will give $10,000 from the partnership firm. The $10,000 is credit, it has gone, and the Rex capital is debit. It means the capital is decreased in the company. So when there is a no bonus, sometime there will be a bonus to the remaining partner. If Rex is saying and withdraw and receive $11,000 as per the capital balance, balance is actually $15,000 as per the balance sheet in the partnership firm. Rex is saying that I want to leave this organization, give me $11,000 and I will leave it, right? So in this case, what happened? The 10,000 definitely will go from the firm. The cash balance from the company will go down by $10,000, which is reflecting here to cash. So it is decreased. Current assets decreased. Rex capital, which it was credit, now it is debit. We want to just set off and make a zero balance for the Rex, because Rex is going from the firm. And so in this case, John and Leo both will get $2,000 each as a bonus to the existing partner. So they will enjoy, they will get that money, because Rex has considered and assumed $11,000 at the time of withdrawing and leaving the organization. Now, bonus to the withdrawing partner. So sometime what happened, the person who is leaving the organization, let's say the Rex withdraw and receive $18,000 as per the capital balance. Rex is saying, I am leaving this organization, but in my balance sheet it is showing $15,000. I want $18,000, only then I will leave this organization. Both partners say it's okay that if you want $3,000 more, we will contribute each other and will give to you. Okay, so our firm ready to give you $18,000. So from the company, $18,000 has gone, it is reduced. The current assets has decreased. So Rex capital account debit is $15,000, because Rex capital is going to offset, making zero, because he is leaving the organization. So zero balance for the Rex further, right? So Rex capital is debited to John capital and to Leo's capital, right? So it is not two, it's just John capital and Leo capital debit. It means that John capital has decreased, Leo capital has decreased by $1,500, and both of them, they have given $3,000 collectively to Mr. Rex, along with the $15,000 that was his own money. Now, death of the partner. Sometime what happened? The journal entry regarding the death of the partner are exactly the same, those for the withdrawal of the partnership. Because partner's death means dissolve a partnership if the partnership agreement does not provide otherwise. By default, if one person or one partner is died, then the partnership will be dissolved. The deceased partner's estate is entitled to receive their equity based upon the provisions that are stated in the partnership contract. These provisions may include some of the methods. Means closing of the books to determine the profit or loss since the end of the previous period up to the date of death. Let's say date of the death is August 2023, and the last time that the books were closed on the December 2022. So from the January till the August, 8 months of period. So they will consider it, whatever the profit and loss, all the transactions, everything will be calculated. They will prepare the new balance sheet till that particular day when the person was died or any partner died. On the basis of that, there will be a distribution of a capital and profit as per they have decided. So determine the current value of the assets and liability. On that day, they will find what is the current value of the assets. If we sell those assets, how much we will get. Accordingly, that money will be given to the to the family of the dead person. So what we have learned? We have learned some of the important transactions related to admission of the new partner, new agreement, and journal entries related to the admission of partner, investing assets in the partners, bonus to the old partner, new partner, withdrawal of a partner, and at the end we learn the death of the partner as well.